Hello, everybody, and welcome to another update. I'm Adam Sarhan. I want to thank you very much for being here. Today, I want to talk to you about another bullish factor that may come into play even more over the next few months and years, and that's something called corporate buybacks. What is a corporate buyback, you might ask? It's basically a company or corporation buying back its own stock. Well, what's been going on? Since 2009, you can see this as a chart of corporate buybacks. Buybacks back then were low, relatively low compared to where they are now, but really have been taking off for the last 10, 11 years now, since '09, 12 years, whatever it's been. So what's happening is you've got a situation where the companies buy back their own stock. It doesn't mean the stock is going to go higher. It doesn't mean the stock market is going to go higher. All it means is the company is buying its own shares. If the stock goes down, they buy it. The stock goes up, they buy it. It's up to them, right? The board sets it. They agree. They try, they go out and do it. So they buy back their own stock. You might ask why? Well, the reason is because it makes the valuation of the company more attractive. And I'll explain that in a minute. So let's just take a look recently. You had a big spike. I mean, massive, massive spike in buybacks from 17, 18, 19, and 20 into COVID. Then March, of course, of COVID happened, and boom, buybacks basically dried up. Why? Because corporations had no idea what was happening or what's going to happen going forward, and they want to hoard their cash, just like people. Once we got through the beginning and middle of COVID, we got more clarity. We realized the vaccines are coming around the corner. People are getting vaccinated. And then boom, you see buybacks spike up again. Why? Because there's something called the price to earnings ratio, the PE ratio. It's a common metric investors use to determine the valuation of a stock. Very simple formula here. I'm not big on formulas, but this is one that's very simple. You take the share price divided by the earnings per share. That's it. Earnings per share. So however many number of shares there are outstanding, it's going to change the number. If you have a lot of shares outstanding, it's going to be a different number than if you have a little bit of shares outstanding. So the simple math tells you want to divide by a lower number of shares outstanding. You get a bigger PE, a better number, a better ratio. Let's put it that way. So because what's fixed, right? The share price is pretty much fixed. Now let's say the earnings per share, let's say they make $2 the company. They're going to divide it by the number of shares outstanding. That's just how the math works. I mean, if you want to read the definition, this is a quick Google search. You can see it. PE ratio is calculated by dividing a company's current stock price by its earnings per share, EPS. If you don't know the EPS, you can calculate that by subtracting a company's preferred dividends paid from its net income and then dividing the result by the number of shares outstanding. All you have to know here is you take the the stock price, divided by the earnings per share. So if you have a lot of shares outstanding, it's going to be one number. If you have a little bit of shares outstanding or fewer shares outstanding, it's going to be a complete different number. That number can completely change. So corporations do their best to keep the number of shares outstanding as low as possible because it helps with their valuations. So now let's go back to this chart here. As we're seeing on the far right side here is that buybacks are coming back in a big way. And that could be a bullish factor for the stock market. Hope you've enjoyed this video. I'll speak to you again soon. Take care, everybody.